Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to go through a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship, the parent owning over 51% of the subsidiary, but not 100%. Therefore, we still do have a non-controlling interest. Our major focus will be on bonds that were sold from the parent to the subsidiary, sold at a premium. Those are going to include some items that we're going to have to eliminate during our consolidation process. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to first go through all of the information in the problem. Then we're going to pull pieces of that information as we work through the problem. So here we have P purchased a percent of S voting common stock on January 1st, 2000 X0. So P is going to be the parent, S the subsidiary. Purchase took place 2000 X0 January of that year. Percentage was 60% that was purchased. That means the non-controlling interest will be 40%. It was purchased at book value, so the purchase took place at book value, meaning we don't have any differential. The assets and liabilities were the same, book value and fair value, so we won't have to deal with that differential in this case. We can put our time and energy focusing in on this component, which is going to be the sale of the bonds. So on January 1st, 2000 X0, P sold bonds to S, so the parent to the subsidiaries, bond being sold from parent to subsidiary. The par value, $78,000. The percentage, 8%. Years, 5-year. Cash received, $80,000. So that means that it was sold at a premium because it was sold higher than what was on the face amount of the bond. So we're going to have that premium that we will be dealing with. Now, as we think of the bonds, remember bonds kind of like issuing debt here that we have, right? P is going to be the parent issuing the bonds to S. It's an intercompany transfer, but between the two then, S would be giving money to P. P would then be issuing the bonds and owing on the bonds. We want to think about the transactions that would be happening related to bonds, related to P and then S, and then how we can reverse them for the consolidation process. Interest is going to be paid annually on December 31st. So the interest payments is not a semi-annual. It's going to be an annual interest payment on December 31st. Fully adjusted equity method will be used. We're going to consolidate as of December 31st, 2000 X1. So that's like 2 years later, because remember that the purchase took place in 2000 X0 January. So we had all of 2000 X0 and now 2000 X1. Straight line amortization of the bonds. So we're going to use straight line amortization for things such as the premium on the bonds. Now let's take a look at the equity method. So we're going to be considering the standard kind of equity method transactions. And what we're doing is reconstructing some of the accounts that are going to be on the trial balances. So we got the trial balance for P, the trial balance for S. S has their recording of the investment, or P has the recording of their investment in S using the equity method. That's going to be accounting for this account and this account down below. So we're going to, in essence, think about how would we generally reconstruct that normal kind of equity method type of stuff. Pulling out the trusty calculator. We're going to say, all right, trusty calculator. I'm going to go down to S down below at the 56,000. We have the 56,000. We got 56,000, and we're going to multiply that times the rate for the controlling interest, which I think was 70.7, I believe it was, which no, it's not. It was 60. So let's do it again. So I'm going to say it's the 56,000 times 0.6. So that's 56,000 revenue minus expenses. This is normal equity method stuff. We're going to say that's going to be the 33.6. So the 33.6 is going to be the investment in S, debit, credit to the income from S. So that's going to give us basically this number. So nothing unusual going on here. We don't got anything very unusual going on here because we're focusing in on the bonds. Then we're going to say, all right, the other normal thing we do is allocate the dividends. So here's the dividends from S. Part of those went to P, 60% of them to be precise. 8,000 times 0.6 is going to be that 4,800. So there's the 4,800. We're going to say increase to cash and the investment. So that's basically the normal equity method type stuff. Now let's think about the bonds. We're not going to go through the bonds since the time of purchase of the bonds. Let's just think about what happened in the current year related to the bonds. Remember that we're basically in year 2, so it's not the year that the bonds were issued. but we're going to think about what would happen with regards to the interest on the bonds. Now, P is the issuer of the bond. So if we just consider what's on the books with regards to the bonds, we've got P's books, we've got S's books. This is as of the current year of consolidation. P is the issuer of the bonds. So when the bonds were issued then, that means that S paid P the cash for the bonds, and then P issued the bonds and recorded the fact that they owe basically, the face value of the bonds back, which is going to be the $78,000. So they have a liability on the books at the $78,000, and they have this premium because they got more money than the face amount of the bonds of the $1 million or the $1,200 here. And then on S's side, they have an investment, basically an asset of the bonds of the $79,200. So these are going to be items we're going to have to reverse, and we want to think about what happened during this time period related to the bonds. Now, we could guess down here, of course. If we look down here, we're going to say one's going to have interest income and the other interest expense, right, on the bonds. So let's look at P. P's the one that issued the bonds. P's the one that then has the bond payable on the books of that $78,000 and the related premium of the $1,200. So they're going to have to pay the interest on it. So the interest then is going to be $6,240. That calculated as, if we take the bonds up top, we've got the face amount of the bonds, 78,000 times 0.08. Interest rate on the bonds, that's going to be the 6,240. So we paid the 6,240. Then we have the bond premium. Now, the bond premium is on the books as a credit, and we're going to bring it down. We're going to bring it down just using a straight line method. It needs to be 0 at the end of the life of the bond. So we're, in essence, gonna use like a kind of like a depreciation type of method, straight line method here. The original amount of the premium was 80,000 minus 78,000. Then we're gonna divide that by the number of periods. Now, there's 5 years. 5 years is not always the number of periods if there's something other than just annual interest payments, like semi-annual or something like also common. But here they are annual payments. Therefore, there's only 5 periods. So we're going to take that and we're going to divide it by 5. So there we have it, and there's the 400. So we're going to be reducing the premium. Remember, as you do this, it's nice to be able to see the trial balance, because then that's easier to remember that a premium is going to be on the books as a credit, and the discount's going to be on the books as a debit. You can also remember it as it basically being opposite of if it's a premium, it's basically increasing the value here of this liability account, so you can increase the liability with a credit. The discount then would be decreasing because it was sold at something less than, and therefore it would have to be on the books at something opposite. Basically, a contra equity account would have to be a debit. And then you could think about how would we make one go down? Well, if this is a credit, then we're going to have to debit it to make it go down. Okay, and then the interest is going to be the difference, the amount that's going to be applied to the interest. 6,240 minus the 400, that's going to be the 5,840. What about what happens on S's books? We, of course, have the opposite that's going to happen here, or the other side of things. So we're going to say, all right, well, cash. And notice I'm going to start here. Notice I started with cash because that's the easiest thing for me to think about, even though it's a credit. So that might look a little funny. You might want to rework it, put the debits on top. But I highly recommend thinking through things and the way that makes the most sense. If you're manipulating things around to try to put the debits on top and it's confusing you, I would just do what it does to make it make sense. And then if you have to make it look pretty for presentation purposes, then make that change later. It's going to save you time. So then here I'm going to reconstruct this in the same format, cash on down, which makes more sense from a debit and credit standpoint here. But it also just makes it a lot easier for me to see. So I'm going to say, well, cash is an easy thing to start with. I could say, well, if this has cash going down, then this one you would think would be receiving the cash. So they should be receiving the cash, same calculation. Then the investment, same calculation. This one had the bond premium going down. This one has the investment in P bonds going down. So same concept. The bonds are on the books at the 79.2. They need to be going down to the 78,000 in essence at the end. So because at the end of the life of the bonds, which was 5 years, so that they can then get paid the bond, the value that's going to be due at maturity of the bond. And then the difference is going to be going to interest income, which of course will be the opposite of the interest expense. So this is going to be what happens on the two sides. And then we could think about, all right, well, what's the difference if we have to eliminate this, because basically we sold bonds to ourselves here. We kind of sold bonds to ourselves. How do we eliminate this thing? Well, you could eliminate the whole thing, right? But you could also say, well, cash nets each other out. Cash nets out. And then I'm left with these four accounts: bond premium, the investment, and then interest and interest expense and interest income. So we're left with these items. We're left with these items. Now, this item is a balance sheet account. This is a balance sheet account. We know when we look at the balance sheet accounts, these are going to have to be removed. You can kind of think at this point to break this out on the balance sheet side of things and the income statement side of things. On the balance sheet, we know we're going to have to remove this, and we're going to have to remove that, we're going to have to remove that, and we're going to have to remove that. On the income statement side of things, it might be a little bit more difficult. So that means these are going to be included in there. We're going to remove them. On the income statement side, we're going to remove the interest expense and the interest income, which you would expect, which you can plainly see here that we would need to remove those because the interest income is now overstated and the interest expense is overstated. The net, once we consolidate, will wash each other out, but there'll be an overstatement on the income side and the expense side that we need to remove. So that's what we're going to do. We're going to remove those. Now, in practice, of course, there may be more than just one thing in the interest. Like here, we got more activity in the interest expense. So it might be a little bit more difficult for us to dig through there and see that as plainly. So it might be useful for us to kind of do the journal entries and consider it. But if we dig down through the GL and we say, okay, who gave us the interest expense, we should be able to find the interest expense, and it should be equal and opposite here, and then we're going to reverse those items. Now let's think about our consolidation entries. We're going to do our standard entry first, and then we'll do the entry related to the bonds that we just put together. So let's bring this on down. Going to bring the little reveal strip so we can reveal it as we go, because that makes things a lot more fun, a lot more interesting. So there we have that. Then we've got P and we've got S. These are their trial balances as of the year that we are consolidating. Our first step, of course, as always, will be to sum them up. So we're going to add them up. So we added up P and S here. This is our total before consolidation and or elimination entries. We're entering the elimination or consolidation entries here. We're going to enter these up until the point in time, the journal entry that we are currently working on. And that's going to be our standard consolidation entry now. Now, nothing's different with the standard consolidation. There's nothing funny going on. We didn't put a table together to manipulate or adjust this one. So we get to go back to kind of like our pure standard normal consolidation entry, the first consolidation entry. So I'm going to start with the investment. I'm going to think about the number a little bit later. Obviously, it's this number, and it is the same number now. You can actually take it, but we'll calculate it as well, just as we have in the past in a second. Then we're going to take off the books the common stock, the retained earnings, and the dividends. So on S's books, we have a credit for the common stock. We're going to do the opposite thing to it to remove it. That's going to be a debit of the $83,000. Then we have the $33,000 on the books as a credit for retained earnings. We're going to do the opposite thing to it to remove it. That's going to be the $33,000. Then we have the dividends on the books at $8,000, debit this time. We're going to do the opposite thing, or a credit, to remove it for the $8,000. So if we record those then, you can see here's what we have on the books for basically the equity section of P. Here's basically the equity section of S. Here's us combining the equity sections of P and S. Here's us eliminating, in essence, the equity section of S to basically bring us back to the equity section of P, these numbers lining up to P's numbers here. Then we look at the income from S. Income from S, we're going to remove this account entirely just as it is right there. But you can think about it, how we've been calculating this. There's been no adjustments to it, nothing funny going on here, so it's the same number. But you can also think of it, how did that number come about with our equity calculation? We took the net income of S, $56,000, from here. And we said multiply it times the controlling interest, 60%, and there's the 33.6 that we're removing. And once we remove that, it's going to remove the entire thing, bringing us down to 0, which is exciting. And then we're going to go to the non-controlling interest. That's going to be this account. And we're going to do the same thing. I'm going to take this 56,000, and this time multiply it times the non-controlling interest, which I believe was 0.3%, which is not, it's not 0.3, it's 0.4. Let's do that one more time. It's got to add up to 100, like the controlling and the non-controlling. 0.4, so there's the 22.4. So there we have that. And then we're going to be breaking this out between the non-controlling interest and the net assets and the investments. So a couple ways we could think about that. You could think about this one first and just zero that out, and this one will basically be the plug. But let's also just kind of recalculate this. We could take the net assets here, which is of S, which is the 5,200 plus the 17,800 plus the 90,000 plus the 303,000 minus the 65,000 plus the 79,200 minus the 112,000 something happened there, 112,200 minus the 199,000, and that should be the 164,000. And if I was to take that and multiply it times 0.4, then we get the 65.6. Notice you could do the same. I should get to that same beginning number if I took the equity section down below, 83,000 plus the 33,000 minus the 8,000 plus, and then revenue and expenses, which equals the net income of the 56. So I'll just take the 56 plus 56,000. I come up to that. I think that's the same number, the 164. And that also is represented by the middle here, from the common stock on down to the income from S. So 164,000 should also be 83,000 plus the 33,000 plus the 33.6 plus the 22.4 minus the 8,000, right? The same number. This middle stuff here should equal assets minus liabilities, or the equity section, which we're now breaking out between the controlling and non-controlling interest. Controlling interest up here is 60, non-controlling at the 40. I'm going to multiply times the controlling interest now 0.6 to get that 98.4. So there it is. This thing should be balanced out. The investment in S, once recorded, brings it on down to zero because, once again, nothing funny going on. Standard transaction. The non-controlling interest in the net income is down below. Non-controlling interest in the net assets up here. Okay, next thing. Next transaction. We're going to go on back down. We've already recorded this one. So this one is included in the controlling, or in the elimination entry column. Now we're going to be considering the items related to elimination of the bonds, which is what we're concentrating in on here. And I'm going to break this out between, for now, a balance sheet side and an income statement side. And in essence, we can kind of look and just see what's on the actual trial balance. What are the balances on the balance sheet that we're clearly going to have to reverse, because this is similar in many ways to like if we had the receivables and the payables that we saw before, reversing accounts that we're going to have to eliminate that should be equal and opposite on the two statements. The thing that's different, the thing that's more difficult about bonds, is we have, you know, premium involved in it, and we also have the income statement side of things now, including the interest that's being paid between the two. So on the balance sheet side of things, I'm just going to go through here and say, okay, well, on P's books, they issued the bond, so they got this 78,000 that they're going to have to remove on the bonds, and the premium of the 1,002, those got to go away because they issued the bonds basically to themselves. And then on S's side of thing, they got this asset, which is the investment in the bond, at the 79,200. That's got to go because they invested it in themselves. Now, note that there could be other things involved here, like those might not be the only bonds. You can see S has some other bonds here that aren't included, but we should be able to look in this balance and say, okay, you know, let's dig down on the bonds that are related to the intercompany transaction and remove those, and we should have subledgers to tell us, you know, where the bonds are coming from, and then we're going to remove all the balance sheet stuff. Then we'll go down and remove the income statement. So it's going to be a straightforward type of activity. This is on the books as a credit, so we're going to debit it to remove it. This is on the books as a credit because it's a premium, so we're going to remove it with a debit. This is on the books as a debit, so we're going to remove it with a credit. And once we do that, then we're just going to post this out. That brings this back down, or back down to what it was without the intercompany bonds, 199. Then we have the premium now removed. Then we have the investment in bonds, that now removed. Now let's go down to the income statement side of things, and we're just simply going to remove the income or interest income and interest expense. So let's do that here. So interest income at the 5,840, we're going to remove that, bringing it, of course, back down to 0. The interest expense down below, it's 5,840. We're going to remove that, bringing it back down to 0 as well. We note at the end of the problem, we got this down to 0, this down to 0. The equity method here representing the equity method for basically P at the end of the day. And we've removed all the intercompany transactions related to the bonds, including those on the balance sheet. They should be removed if they're related to the bonds. And those on the income statement, which would include typically the interest income and interest expense being overstated.